We are joined by a Harvard professor who knows a lot about how the economy works. Ed Glaeser, thank you for being with us.
Thank you so much for having me.
And we've got to talk about today's jobs report. Your colleague Marty Feldstein said it was just awful. Nobel Prize winner Dale Mortensen said he was quite disappointed. What's your reaction? 103,000 jobs added versus the 150,000 expected.
Well, certainly it is disappointing. Certainly we were all hoping that we'd turned the corner, and we clearly have not yet placed ourselves on a permanent upward trajectory. But I think for many of us, this is less of a surprise than perhaps it might be, right? I think many of us thought that we were in a long, slow slog of a recovery, that this was going to be painful. And it also reflects, I think, permanent challenges facing the U.S. economy. And I think that's really an important thing going forward, is this is not just about a cyclical dip that we need to come out of, but it reflects major league problems that are facing America going forward.
Is there a policy response that's missing here?
You know, I tend to think it's easier to think about long-run policies than short-run policies. I don't think there's some magic potion that's going to create new job growth automatically. I think the key for the government is to try and get fundamentals in place, and that means a reasonable tax policy. And I strongly support the Bowles-Simpson tax reform plan. I think working towards a system that had lower marginal rates across the base, a broader base, but fewer minor exemptions for things, including the home mortgage interest deduction, would be a big step forward. I think thinking about particularly the human capital base of America is what's really important. I mean, one of the things that's so striking about the recession is that the unemployment rate for high school dropouts is 15%. The unemployment rate for people with college degrees is less than 5%, right? This is a huge difference in terms of the experience of this downturn based on your education. And, I think as we think about what kind of country we're going to be leaving to our children, education is the story. Human capital is the story, because our country will rise or fall on being smarter, on being more innovative, on being more agile than its competitors.
So stimulus for the education sector?
I don't think you want to think about stimulus. I don't think you ever want to think about stimulus in anything that's a long-run investment. I think it was a mistake to think about infrastructure as being stimulus, because it's impossible to make investments either in education or in infrastructure quickly and wisely. All of these things take time to go forward. You can't build a sensible bridge or a tunnel overnight in response to a downturn. We need to be thinking about policies that will strengthen America in the decades ahead, and that requires not the short-run perspective of how do I fix next month's jobs report, but the long-run perspective of how do I create a stronger country for our children.
So what is the time frame? Dom Chu just gave us an analysis that said 12 years. Ben Bernanke said about 4 to 5 years towards normalization in the labor market.
I would not be prone to sort of be so tight on this, but I think I would probably be closer to Ben's number than towards a longer number than that. That certainly sounds plausible. I think it will be many years before we reach anywhere near boom heights in the housing market as well. I mean, the housing market is an area in which it's quite easy to figure out at least what you need to see before you'll get back to normal housing production levels. We basically need to work through the tremendous stock of overbuilt homes that is hanging over us from the boom, and that's going to take several more years at the current very low rate of household formation to work through that.
How important is that to the economic recovery?
It's in terms of the overall economy, it's not huge. In terms of particularly low-educated portions of the population, the construction sector is important, and I think it's one aspect. But you can certainly, the view that you can't have a recovery without housing coming back, I think that's wrong. I think actually it's certainly possible to imagine a recovery with very little housing, but more construction sure would help.
We have to change, you've written, the way we think about housing. It doesn't necessarily have to be that everybody owns a house.
No, absolutely. And I think that's one of the things that I liked about the tax reform proposals, is that we rethink the home mortgage interest deduction in the wake of the tremendous housing convulsion of the past decade. It just seems insane to have a government policy that tries to bribe people to leverage themselves to the hilt to bet on the vicissitudes of housing, right? We are an extraordinarily well-housed population. The square footage per capita of an average American living in the bottom quintile of the population is double the square footage per capita of someone living in England or France or Germany. And the home mortgage interest deduction is wildly regressive. The average benefit for a family earning more than $250,000 a year is 10 times a family earning between $40,000 and $75,000. The home mortgage interest deduction encourages us to buy bigger homes, and that's we need to rethink this. It's a sacred cow that's in need of a good stockyard.
That's a good line to end on. Thank you very much.
Thank you.
Ed Glaeser joining us today from Harvard University.